Ceramic tile maker Italtile's full-year headline earnings per share increased 18% to 41 cents. This despite its subdued trading environment. Joining me now on the line from Johannesburg to unpack the numbers is the group's CFO, Peter Swatton. A very good morning to you, Peter. Now looking at the results, Heps up 18%, we have turnover up 16% and sales up 26%. Is this a reflection of the market or are you just overachieving?
Morning, Mashudu. Perhaps we'd like to think a little bit of both. I think that the market itself has been a little bit stagnant. We haven't seen much growth in consumption. But certainly we've maintained our position and I think we've maintained our market share inside that market.
Indeed, like you say, the trading environment has been quite difficult, really looking at competition issues which have been quite intense. To what extent did the renovations segment of the business help cushion the company?
Well, it plays a significant role, obviously, in our results. I mean, we trade right across the segment with three brands. The CTM, obviously, is the biggest component of our business, and that targets predominantly the renovation market. So generally in bad times, renovation picks up and we're well positioned for that.
You have also managed to gain a market share. Talk us through your competitive advantage. How did you manage to gain market share in such an environment?
Well, in essence, and without being facetious, I think retail is simply about providing product people want and having it stock at all times at price positions that they can access. And I think it's probably true for most people that if you have a retail experience, you go into a shop that either haven't got your size or the color or whatever it is you actually want. And we've taken a concerted effort over the last 12 months to certainly be very deep in stock holding across our entire range, and I think that's stood us in good stead.
You also opened 3 stores within this period. Are there any plans to open more stores going forward, and what kind of time period are we looking at here?
We've always taken a very conservative view on organic growth. We've always rather extract maximum advantage out of our existing store footprint, which we think we can do, and we spend a lot of time either renovating or extending our trading areas. So we've opened 3 stores. We think there's room in the country across all the brands for maybe 15, 20 plus stores, but we've always adopted a very conservative growth strategy, 3-4 stores a year, and I think we'll continue to do that.
You're looking at growth within the South African market. Are there any plans perhaps going further afield, looking on the African continent?
Oh, absolutely. We trade in 18 countries. We've taken a very concerted look at East Africa, particularly in the Uganda, Kenya, Tanzania space. We've now recently, the last week or so, opened another store in Nairobi, and I think there's huge growth potential in sub-Saharan Africa.
When you look at your Australian operations making a loss this period, would you say that it is time to perhaps exit that market?
I think it's time to probably have a look at the trading model. We entered that market as retail specialists in ceramic tiles. We've had a look at our trading formula. We've changed it. We're now going to be more of a general merchant in floor coverings. We've got a couple of pilot stores up and running. It's again early days for us, but I think if we tweak our trading formula into that market, we might be more successful.
You're looking to acquire about 15 and 20% of ceramic tile makers. Talk us through the background of that transaction and how it is likely to enhance the business going forward.
Well, interesting enough, Ceramic Industries and ourselves used to be one company up until it was August 1991. At that stage, we decided to list both retail and manufacturing entities separately, for each to find its own destiny. Because to run a vertically integrated group is very difficult. It's not the most efficient model. But over the years, given our growth that we've achieved over the last 24 years, it's become painfully obvious for us that we have to start vertically integrating back into a supply chain, which we've been doing in the various product segments over the last 3 or 4 years. We've taken the view that although ceramics are the biggest manufacturer and we are the biggest retailer, we need to have a closer association with both companies. So we've taken the view that we don't obviously want to integrate them back. It's not an efficient model, but we certainly want to bring the organizations closer together. Hence our offer to ceramics to acquire up to 20% an equity interest in there. We've taken great pains that both companies will maintain their work ethos, they'll maintain their presence in the individual markets. But given our growth potential, we need access to more and more products from our supply chain, and hence our decision to acquire a strategic interest in ceramics.
Looking at growth potential, some positive results in the first half of the year. Could we see the second half of the year being even better than what we saw now?
I think conservatively we'll probably continue the growth trend that we've experienced over the last couple of years. So we are fairly ambitious about what 2013 holds for us.